in the last 18 months to 24 months, I've seen like a new spin on these policies, right? It's a one-off payment. You go and you then go right away and collateralize it with a third-party bank who will then make the premiums from year 2 to 10. You rack up a tons of loans, but in theory, the cash value will always be higher than those loans. And it's a way of juicing up the spread, so to say. What is your take on these policies? Like them, hate them, and if you hate them, why?
So that is a very sophisticated strategy, which I've seen all of the exotic stuff. It's called premium financed life insurance. So we actually do that. And we do that with folks that have a net worth of $20 million and up. There is a different reason why you would do those than what a lot of folks are sharing. They're trying to show, oh, you have leverage and you're growing it. And they're showing projections, usually using universal life policies, which is based on the stock market, which is based on average rate of returns. So that whole thing is that presentation should start with once upon a time. What we do is we do it as part of estate planning. So there's a couple of ways that the strategies from a very sophisticated life insurance strategy. So the first thing is access to liquidity now. That's what I just showed you, producer's capital account, this strategy. Cash now, set up your high cash value life insurance, your dividend paying whole life insurance policy with a mutual insurance company, and you have cash for your business and your investments now. Then there's a second strategy, and that is getting your maximum death benefit amount. Now, when your net worth is under 20 million, what you can do is, let's just say you set up a policy and your total death benefit, let's just say 5, but life insurance will underwrite you for 20. What you can do is you can add 15 million in a convertible term. So you have 5 million whole life, 15 million in convertible term, and now your total death benefit is 20. So if you die at that stage, your trust or your beneficiaries get 20. Now, why is that a good strategy? Number one, it's the lowest insurance cost for that 20 million. You have cash now, access now, through the high cash value, and you have the convertible term, which you locked in your health at the time when you put that up, that can be converted into chunks throughout that 20 years that term is good for, without medical underwriting. So you've set yourself up that you'll be able to set these policies up for the next 20 years. And that's what I did that personally for myself too. That's why I still have some convertible term. And the policy that I set up for myself in December, I actually converted some of my term over. Now that's the second strategy. So first one, cash now. Second one is cash liquidity at your death to your trust or your beneficiaries. Now, then there's a third one, and it gets a little bit sophisticated. So you can have a trust buy a life insurance policy. Now, instead of funding the trust where there's gifting now involved, and again, I'm not a lawyer, and I'm not an estate lawyer, but there's a limit to the gifting that you can do from you into that trust. So how do you get around that? If your net worth is over 20 million, what banks and financial institutions and family offices lend on this too, they'll lend you the money. They'll lend the trust the money to buy that policy. It gets around the gifting. So now there's no limit on gifting. You could fund that trust. So let's just say they lend you $1 million for 10 years. Now you've got $10 million that just went into that trust, got around the gifting, is in there tax-free in the policy. And in 10 years, you probably have 12 million in there tax-free. You take a policy loan in year 11, you pay back the banks or the family office that you borrow it from. And then now you're netting, let's just say 2 million tax-free in there with your death benefit, and your policy is in there. That's one of the there's so many different strategies with finance life insurance. When does this fall apart? The interest rates are challenging in that space, number one. So when you have exotic designs like the stuff that I've seen, they call it Kaizen. It's when you pull all these funds together and now they're lending on these policies. there's very thin margins for errors. So if one thing's off, remember, when you and I try to control something, if you have one variable, it could be challenging. If you had two, harder, three, more harder. When you literally have four variables, whether it's interest rates going in, the stock market needs to do this, the life insurance company needs to credit this because they have to be profitable. So their crediting has to be at a certain level. So you have 3 or 4 variables which you can't control. That's why I don't like it. That's why it's too exotic for me. We prefer the trust, the proven things that have been done for a while. These premium finance life insurance policies have been done, for a long time by very wealthy families. They do them in family offices all the time. Our partner that does that within our firm, I mean, he spent 2 decades in the family office space. I've learned a lot from him why these exotic things when it comes to that financing structure isn't something that you would want to pursue.